Tesla, once the undisputed king of the EV revolution, a trillion-dollar tech darling now stumbling through 2025 with serious headwinds. Sales are down, margins are crushed, sentiment is shifting, and Elon Musk's focus appears scattered. So what exactly is going wrong for Tesla this year? In this video, we'll walk through 10 critical factors driving Tesla's stock down in 2025, from declining deliveries to political backlash, and what it all means for long-term investors. Now, just before we get into it, this video sets the stage ahead of Tesla's official Q1 earnings release, which is expected in the next few days. Think of it as part one, the pre-earnings picture. I'll post a full follow-up once the numbers are out, so if you want to stay updated as this story unfolds, make sure you hit the subscribe button. All right, let's get into it. We start with the headline numbers, and they are not encouraging. In Q1 2025, Tesla delivered 386,000 vehicles globally. That's down 9% year over year, and more notably down 20% from the previous quarter. This marks the first year-on-year drop in deliveries since the early pandemic days of 2020. And it's a major red flag for a company that until recently was promising 50% annual growth as its base case. If you zoom out, Tesla's delivery growth has clearly plateaued, selling a very similar number of cars in 2024 as to what's estimated for 25. So potentially flat at best, if not down. Now let's talk about China. Once Tesla's golden goose, Tesla's China deliveries are down approximately 15% year over year as of Q1. And that's after repeated price cuts. The problem? Fierce local competition. BYD, NIO, and Xiaomi are all gaining ground rapidly. BYD now outsells Tesla in the pure EVs within China and at a lower price point. What's more, there's a growing nationalist consumer shift. Chinese buyers are showing a stronger preference for domestic brands, especially as tensions with the US persist. Tesla's Shanghai factory, once its most efficient and profitable, is no longer the edge it used to be. Back home, US demand is soft, and that's despite aggressive price cuts. The Model 3 and Model Y, which still make up over 85% of global deliveries, are now selling for up to 20% less than they did 2 years ago. The Model Y long range, for example, has dropped from $66,000 to under $50,000. But even with these discounts, interest rates remain high and monthly repayments for EVs are still out of reach for many Americans. Combine that with rising insurance premiums and limited charging infrastructure in some regions, and you've got a demand problem. And don't forget hybrids. Toyota, Ford, and Honda are all seeing a resurgence in the hybrid sales, pulling potential buyers away from full EVs. Over in Europe, Tesla's momentum has slowed dramatically. Germany and Norway, two of Tesla's strongest markets in the region, have both seen double-digit declines in Tesla sales through Q1. One major factor, expiring EV subsidies. Countries like Germany have rolled back incentives, and Tesla's price point suddenly looks less attractive. Meanwhile, Volkswagen and Renault are regaining market share with affordable EV options tailored to local preferences. Tesla's once massive lead in European EV adoption is slipping. Now let's talk about the Cybertruck. Tesla's most hyped launch in years. After years of delays, the Cybertruck finally hit the road in late 2024, but it's been far from a blockbuster. Early reviews have criticized its chunky design, lack of real-world utility, and poor fit and finish quality. But the biggest issue is volume. Tesla delivered only a few thousand Cybertrucks in Q1 2025. That's less than 1% of total deliveries. Production has been constrained by complex manufacturing requirements, and cost overruns have made it difficult to scale profitably. At one point, Tesla had over 1 million reservations for Cybertruck, but as of now, it's not clear how many will convert. For a company that desperately needed a new growth product in 2025, the Cybertruck hasn't delivered, literally or financially. Now here's where it really starts to hurt: profit margins. Tesla's automotive gross margins have dropped 16.5% in Q1, down from 19.3% in Q4 of last year, and way down from 25% in 21 and 22. And that's not just a cyclical drop, it's a structural decline. With price cuts across every model and rising input costs, from lithium to labor, Tesla is being squeezed from both sides. Operating margins have followed the same trajectory, now sitting near 8%. compared to over 15% in their peak. For context, legacy automakers like Ford and GM are hovering in the 6 to 8% range. Tesla is no longer a standout on profitability. This margin erosion is part of why institutional investors are re-rating Tesla, from a disruptive tech play to a more traditional cyclical automaker. Next up, full self-driving, or rather, still not full and still not driving. Tesla has made incremental improvements to its driver assistance software in 2025, but regulatory approval remains elusive. The National Highway Traffic Safety Administration reopened an investigation into autopilot-related crashes earlier this year, citing inconsistent safety outcomes. Meanwhile, competitors like Waymo and Cruise are rolling out fully autonomous robo-taxi pilots in limited geo-fenced areas. Tesla, by contrast, continues to rely on vision-only systems and driver oversight. The market is losing patience. Tesla once promised a fleet of self-driving robo-taxis by 2020. In 2025, that promise is still a dream, and now investors are beginning to discount FSD entirely from their valuation models. Now let's talk about the elephant in the showroom, public perception. Elon Musk has taken a very public stance supporting the Trump 2025 administration, especially around deregulation, immigration, and social policy. His vocal criticisms of US institutions, media, and even the Biden-era EV incentives have polarized public opinion. As a result, Tesla, once the poster child of green tech, is now seen by some consumers as politically divisive. According to a 2025 Morning Consult Brand Index, Tesla's favorability among Gen Z and millennial consumers in the US has dropped by 14 percentage points year over year. That's a massive swing, especially in urban coastal markets where Tesla has historically dominated. Worse still, ESG funds are starting to pull out. Tesla's governance score has fallen in multiple indexes, and its S, the social pillar, is under pressure. In short, Elon Musk's personal brand is now bleeding into Tesla's commercial brand, and not in a good way. Let's now look at leadership and operational focus, another area where Tesla is losing altitude. It's no secret Elon Musk wears many hats. In 2025, he's actively involved in X, formerly Twitter, SpaceX, XAI, Neuralink, and yes, still Tesla. But there's growing concerns that Tesla is no longer his primary focus. Internally, multiple senior engineers and operational leaders have left the company over the past 12 months. There's no clear, empowered COO or president running day-to-day strategy. Shareholders and analysts alike are asking who's driving the ship. This lack of bench strength is starting to show in execution. From Cybertruck ramp delays to slow software rollouts and operational inconsistencies in new factories, Tesla isn't just losing sales, it's losing internal focus. Years ago, Tesla promised a diversified business model. Not just cars, but energy generation, solar, and battery storage. Fast forward to today, and that vision still hasn't materialized in the numbers. In Q1, Tesla Energy contributed just $1.1 billion in revenue, or about 5.8% of total company revenue. That's an improvement year over year, but still too small to move the needle, especially when automotive revenue is declining. Worse, operating margins in the energy sector remain razor thin. Despite record solar deployments in California and Australia, profitability still hasn't scaled. The takeaway? Tesla remains a car company, and that means investors can't rely on solar or batteries to offset softness in its core vehicle business. Now let's talk about the market's cold math. At the start of 2022, Tesla traded at a forward PE of nearly 120. In early 2025, that number has come all the way down to the mid-30s, and it's still falling. Why? Because growth is slowing, margins are compressing, and future cash flows now look less certain. The market is adjusting its expectations. Tesla is being re-rated not as a high-growth tech innovator, but as a maturing automaker with cyclical exposure. To be clear, a 30-plus P isn't cheap, especially compared to Ford at 8 and GM at 6. The only reason Tesla still commands a premium is the hope that autonomy, energy, and AI might eventually pay off. But as those timelines stretch further out, fewer investors are willing to pay for the dream. The result? Institutional ownership of Tesla shares is quietly declining. BlackRock, Vanguard, and other large players have trimmed Tesla exposure in 2025, reallocating to large cap names with stable earnings and better risk-adjusted returns. Retail investors were once the lifeblood of Tesla's meteoric rise, but even among the loyal base, sentiment is shifting. In April 2025, a retail investor survey by Fidelity showed that only 37% of self-directed investors considered Tesla a buy, down from 65% a year prior. Social media buzz around Tesla has also declined. Reddit's TSLA is quieter. YouTube creators who once focused heavily on Tesla content are now pivoting to Nvidia, Palantir, and energy names. The story is changing, and that matters. Meanwhile, analysts are growing more cautious. Morgan Stanley cut its 12-month price target from $345 to $225 a share, citing margin deterioration and strategic drift. Barclays now rates the stock underweight. This shift in tone is a warning sign. When the story stops working, the stock tends to follow. Tesla's original moat was being first, being best, and being bold. But in 2025, they're no longer alone. Here's a snapshot of just a few major developments. BYD is now outselling Tesla globally in EV units, including plug-in hybrids. Their vehicles are cheaper, more localized, and often better suited for developing markets. Rivian and Lucid are holding strong in the US premium EV market, while Hyundai and Kia are winning the mid-range price war. Ford's Mustang, Mach-E, and F-150 Lightning are growing their footprint, particularly in North America. Xiaomi's SU7 sedan is a breakout success in China, undercutting Tesla on price with competitive range and interior tech. Tesla's once sky-high lead is shrinking fast, and unlike 2019 or 2020, consumers now have real alternatives and they're voting with their wallets. Zooming out, the macro environment in 2025 isn't helping. Interest rates remain elevated, with the Fed fund rate hovering near 4.5%, making auto loans more expensive. In Europe, the ECB has held off on further rate cuts due to sticky inflation and pressuring consumer credit. EVs, especially premium ones, are discretionary purchases, and when borrowing costs rise, those purchases get delayed or abandoned. Tesla models, even after price cuts, still sit at a premium to many alternatives. That makes them especially vulnerable in a tight credit cycle. Additionally, energy prices are stable, meaning there's less urgency for consumers to switch to EVs based on cost savings. So what's next? Is there a path forward? So where does Tesla go from here? There are still levers to pull and reasons for long-term holders to stay optimistic. For example, Tesla is expecting to unveil its long-awaited Model 2 compact vehicle later this year, which could open up new markets if pricing hits the sub-$25K range. The Dojo AI training supercomputer remains a potential differentiator in autonomy and robotics if execution improves. Global energy partnerships, especially in Southeast Asia and Australia, could eventually turn the Tesla energy business into a more meaningful revenue stream. But make no mistake, the bar is higher now. Investors need to see delivery growth, profitability stability, and leadership clarity. Hope and hype are no longer enough. The stock may still offer long-term upside, but only if the next 2 years bring measurable results, not just headlines. So Tesla's 2025 stumble is more than just a quarterly miss. It's a fundamental turning point, a shift from hyper-growth to operational reckoning. Deliveries are down, margins are shrinking, the brand is more divisive, and the valuation premium is under siege. For long-term investors, the question isn't whether Tesla can recover. The question is how, and how quickly. Because in the new EV economy, the competition is real. The narrative has cooled, and the market is watching very, very closely. If Tesla wants to reclaim its throne, it'll need more than software updates and viral tweets. It'll need execution, clarity, and consistent delivery in every sense of the word. Now that wraps up our in-depth market breakdown of Tesla's turbulent 2025. If you found this helpful, consider subscribing for more investor-focused analysis. Drop a comment below. Are you holding, trimming, or steering clear of Tesla right now? Would love to hear your thoughts.